We've decided that the best way to do this is to not own stocks. And we can do this synthetically. And we've trademarked the term SynthEquity for synthetic equity. We can do the synthetic equity approach by buying options that can attempt to replicate the movement of a portfolio with only a fraction of the capital at risk.
Larry, welcome to the show, man.
Thank you, Ryan. Great to be a guest here. I've listened to a couple of episodes, and you've got a great thing going and sharing all this knowledge from various businesses and focus on finance. It's great. Great to be here.
Yeah, it's great to have you, brother. Man, you've put something together so incredibly awesome. I cannot wait to get into this. So let's jump in, man. If stocks are optional, why does Wall Street worship them so much?
Right. So I think that the basic American economy, the U.S. market, and I measure that by the S&P 500, is really the power engine of American commerce. And particularly the S&P 500 is like this super engine. It's the all-stars, the top 500 largest companies. And it's a self-healing or self-repairing index because the constituents that were in it 20 years ago are not the same players today. Anybody that can't keep up with growth just gets pushed down off of the index, and the hot players that are making a killing grow up to the top. And that's why we have companies like Tesla, up in there now, driving it forward. And every day the CEOs of these big public companies wake up with a mission, literally, from their boards and from their shareholders to deliver value. And that is a relentless pursuit of dominating their areas. And I think that's just a fantastic place to attach your wagon and let that horse run.
Yeah, I love it. The S&P is a magical thing, and it's often a benchmark used around the world. But you see it a little bit different. And so my question is, when did you realize that modern portfolio theory was broken?
So for me, it was as a young advisor I have to go back now 25 years. And we were working and building portfolios for clients using optimization software, diversifying among different asset classes. And that is kind of the idea behind modern portfolio theory, is trying to extract the best value for the least amount of volatility. And what we found as the tech bubble burst in the end of the 1990s and into the early 2000s is that the correlations that need to be different when you build a portfolio based on diversification can become correlated, and they can actually all start to go down at the same time. And when we had a client call and say, geez, Larry, how much worse do you think this is going to get? Not being able to answer that question and not being able to put a number on it for the client is the cause and the root cause of anxiety and fear. And when that anxiety and fear creeps into the decision-making process, nothing good happens. So what we found is that if you have a basket of diversified holdings, it doesn't matter if it's 17 positions or 1,700 positions. If they start to go down in value and you can't put your finger on what the losses are going to be, then you have a problem. So we wanted to solve that.
Brilliant. You and I, when we first met, I remember you telling me a story about when you're in insurance, and there was a practice that the asset managers would get the lion's share of revenue. And, when markets start to become unglued, I remember this saying that you told me, is you said that was the moment you saw uncorrelated things start to become correlated. I wonder if you can unpack that moment where you really started to understand, and that has led to the theory that you're doing now and the fund that you built.
Yeah, well, I just realized that if something is worth, let's say, you buy a share of something or an ETF or a mutual fund, and it's worth $64.10, and it's dropped by 10% to something in the $50 range, there's nothing stopping it from dropping another 10%, and then another 10%, and another 10%, because there's no limit to the amount of loss that can happen. And the correlations, we're looking for investments that I was taught in early on age that you always want to have something going down in your portfolio, because if everything's going up at the same time, that means that you're almost assuring yourself that if there's a loss, everything's going to be going down at the same time. I found this not great. It's mathematically correct, but it's not great because you have to have something dragging down the performance of your portfolio in order to be successful, right? You're literally saying, I need losers in order to build a diversified portfolio. And then when you buy these things and you put them into your portfolio and mix them up, when we get a crisis, then they all start losing at the same time. And this idea that you're going to diversify your way into a safer place, I just don't believe it. And neither do clients, frankly, when the proverbial crap hits the fan.
And it certainly did in 2008, as I well know, as among many millions of people around the world as well. So you took a different strategy, right? So we're talking about the supposedly uncorrelated things start to become correlated depending on, we'll say, a black swan event. And with that, it started to breathe life into a little bit different strategy which is synthetic equity. So maybe walk us through a little bit, how do you synthetically capture equity upside with options? Because I know that's a big part of what you do in your fund. Maybe walk us through a little bit of that.
Yeah. So I don't want to get too technical and get into Greeks and optionality and that kind of stuff, but the concept is very simple. What I've come to believe is that I can't limit the losses in stocks and still own stocks. So what we've done is we've decided that the best way to do this is to not own stocks. And we can do this synthetically. And we've trademarked the term SynthEquity for synthetic equity. We can do the synthetic equity approach by buying options that can attempt to replicate the movement of a portfolio with only a fraction of the capital at risk. So rough numbers, about 15% of the portfolio is required to move the needle sufficiently so that the other part of the portfolio, which is held in really the safest asset class we can find right now, which is US Treasuries, short duration Treasuries. And that's what gives us the floor. If we have roughly 85% in Treasuries that don't respond much at all to market movement because of the short duration, and we have a tremendous amount of volatility in the 15%, I mean, like really tremendous. What we're doing differently, I think, really is that we're prepared to lose all of that 15% because we can't lose any more. I mean, assuming the Treasuries don't have a catastrophic failure. But assuming that that's the case, then we're putting all of our risk into the 15%. And when we do that, we're getting the benefits of what essentially is concentrated risk as opposed to diversified risk. So concentrated risk is the type of risk that can really move the needle. And when we go to cocktail parties, nobody ever comes into a cocktail party and says, "Oh my God, last year I crushed it, my fully diversified portfolio." That just doesn't happen. What does happen is someone comes in and brags about the fact that they put half of their money into crypto, or they put half of their money into Nvidia, or all their money into pick the name that's hot today. That's where big dollars are made. And I got news for you. Options can move even faster than either of those things I've just described. So a properly structured option contract can move at, let's call it the speed of light, but effectively 3 times, 5 times, 10 times, 20 times the speed of the market. And it's just a question of probability. The bigger movement comes with lower probability. So what you're hiring us to do as a professional manager that has trained in this now for over 20 years is to understand and weigh that probability against the speed that we need. So it's really a sizing thing, almost like a lever. The bigger the lever I have, the easier it is to lift a heavy object. And the shorter lever, more difficult. And that option piece is what makes it possible.
Okay. So for the options and also the Treasuries, is that like a 6-month? Is that a 10-year? Is that, I'm being ridiculous. I know 10 years not a thing, but how far out do we go where that makes sense?
Well, let's start with the Treasuries, because that's the part where we really put all of our safety is in that. And so we want to be on the short end of that curve, very short. So we build a very straightforward 90-day ladder, which means that we have just four bonds in the portfolio, and they mature every 90 days. So we have basically roughly a quarter of the portfolio coming due, and it just gets redeployed out to the next 1-year tranche. So that's kind of what would be, I think, widely considered a very safe investment vehicle. It's not really meant to do anything, frankly, except not lose money. Then we're not really asking it for a heavy lift. We're asking it to not go down in value. The balance with the options will typically put out to about a 1-year duration. I say about because sometimes we don't have strikes in the right place, and we purchase option contracts that are adjusted and structured to attempt to be able to keep up with the S&P 500. So we're looking to capture that rate of return if we can when the market rises, and keep a defined downstroke in place because of the heavy treasury allocation. The next thing that we do that's unique to our firm, and that is that we don't do this on like a 1-year basis where we just buy the option contracts and don't ever look at them again until we see what happens a year later. We buy the option contracts and then actively manage that piece. So if the market does move up like it has in the last 10 days, we will be actively selling that option contract at a gain, taking a portion of those gains and buying more treasuries. So we raise the safety balance, and then we deploy the remaining capital out into a new option tranche. And what that really does also uniquely, very different than, say, a traditional holding in VOO or SPY or the big, investable index ETFs, is that after a period of time, our clients will have more in the treasury component of our fund than they gave us to invest at the outset, meaning that their capacity to go backwards is mitigated. If you put $1 million into a tradable ETF exchange that tracks the S&P 500 and you're successful and it doubles, let's say in 5 years, you're literally just one bad, 50% decline away from giving it all back. You don't get to keep any of it because it's all still at risk. And with our structure, each incremental step up becomes a new floor against which you have a very difficult time piercing.
Good. Brilliant. And how durable is that floor in say an '08 or 2020 style crisis?
Well, it's going to be what the wiggle is on the, and I say wiggle because there's going to be probably some vol in the treasury space. It's not entirely immune, but what we have to realize is that like a quarter literally of the portfolio is coming due within, let's say 90 days at the longest. And then the next quarter is going to be another amount. So if there's a markdown to the treasury component, it's likely to be modest. It's not necessarily going to be zero, but it's likely to be modest. And we shouldn't have to sell those treasuries until they mature. Or actually not even selling them, we just wait till they mature. So we don't even suffer a real loss. We just might be a small markdown.
Mm-hmm. Great. And so those short duration bonds with that ladder strategy, that really sounds like it's holding up well. So, if the market goes pretty wild like that, you have that nice healthy floor to protect the downside risk. I think is a big part of that.
That's the meat and potatoes, right? So people that are familiar with option strategies may think we're writing covered calls or we're buying protective puts. We're not doing any of that. What we're doing is we're taking the long synthetic approach by actually buying calls and attempting to replicate through some what's referred to as delta adjusting the notional risk so that we can have the small part of the portfolio move at a rate of speed that is large enough to compensate the entire portfolio for a comparable return in the market.
Awesome, man. Great to know. So my next question, talk about how SynthEquity may underperform outright equity.
Yeah, there's actually sort of three environments that we operate in. We have a declining market that is modest. So let's say we have a market that's, sort of steadily grinding down, but only a small amount, maybe 2 to 3% over 6 months. That's really not good for our strategy. And the reason it's not good for the strategy is that our options are predominantly made up of time value, or basically the gunpowder on a fuse. We buy an option contract. It has a finite amount of life in it. Ours is typically about 1 year when we purchase them. And if things don't happen positively and the market doesn't rise, then that time value just is on a relentless decay. It's almost like literally watching the fuse go, and, get to boom, done. So that's a market. And it can also happen if the market's only appreciating a little bit. Like if we only go up 1%, but it goes up 8 basis points a week over the course of 5 or 6 weeks, that's also going to, likely result in time value decay. During that time period, we can underperform. And that's happily not very often. It's not never, but it's not very often. What typically happens is the market runs in very, very rapid spurts, both up and down. And I think I also learned a long time ago that the market takes the stairwell up and the elevator shaft down. So it tends to take a long time to grow a portfolio and then just moments to have it reset itself back to a lower price. In a really big sell-off, then we earn back that earlier deficit, because if the market's down 20 or 30%, we just, based on what we talked about earlier, we likely can't go down that far just because we have this floor of treasuries to support us. And by the same token, there's a feature in options that when the market's really on a tear, the participation rate, the amount of money you actually earn from the options we own, starts to accelerate on how much we're actually earning. So instead of something that sort of loses gas as the market rises, these option contracts that we purchase actually accelerate and they start to deliver higher rates of return than the market itself. So that's our cue to sell. So we can substantially outperform, and we have in the past, when the market is running hot. So those two opportunities allow us to get money in the bank to offset the time periods when we will underperform, when there may be some low vol or periods of time when there's not enough movement in the portfolio or in the markets to drive the portfolio.
Okay, brilliant. And when it comes to, let's say, some of the fragility that exists in all funds in the market, like slippage, volatility crush, liquidity, where do you see some of that fragility may show up?
That is actually an area where I'm not very concerned. And the reason I'm not very concerned is that the two markets we're trading in, we literally only have two places we're shopping, and that's US Treasuries short duration. That's got to be the largest market in the planet, for both liquidity and stability. And then the second piece we're trading in is on options and derivatives on the S&P 500, also the biggest global market for equities. So those two things we tested before we launched our exchange traded fund with a single $1 billion transaction to see if we could move $1 billion without much slippage. And it worked out to about 4 basis points. That's a very digestible type of exchange or slippage for being able to bring that much risk control to that much capital in one transaction.
Brilliant. You don't really have any liquidity issues. Again, you said in a rare sense, you may have a little bit of that theta issue, the time decay.
I wouldn't say it's rare. I mean, the time decay theta is happening every day. There is basically a headwind that we're pushing. against. The question is there enough energy in the market movement to offset it? And this slippage can be daily, it could be weekly, it could be monthly. So we're happy. We're a little bit over 6 months from our ETF launch. I think I mentioned to you this morning, we crossed over $100 million of assets raised from just a very small seed deposit initially. So we're stoked with that. And also, through the end of the last quarter in September, we've outperformed our benchmark, the S&P, net of our fee. As advertised, it's been a great run. We're up over 20%. The market's been stellar as well, and that's the kind of environment that we do well in. So that's how it works. But no, theta is the enemy. That is absolutely what we're up against.
For sure, 100%. And that's why we talk about it. We're having a real discussion about that. And thank you for being there. Now, we've been talking about strategy up to this point and how you build it and stack, and that is great. But there's also clients that will say hire you, but not, maybe that's not the best term, but clients that invest. I know you spend a lot of time in that. And so working with clients is a big part of what all asset managers have to deal with, not just you. I deal with it too. So how do you keep clients calm when maybe things in their mind, maybe the market, the sky's falling, or whatever it is that they're freaking out about? How do you keep them calm with some of these options that they might be fluctuating? What do you do there?
Yeah, I think the strategy is built to do this. It's purpose built for that exact outcome. And it's why we have it. We have a relatively new guy with our company. He came from South Africa, and he's more than an intern, but he was here initially, and he is just blown away by the fact that we do have something like 500 families that we manage money for, in addition to managing money for external advisors and relationships there. And when we had like the April swoon here, when the tariff announcements came out and all hell broke loose and the market sold off like 13 or 14% in 2 trading days, he said he just is blown away because we don't get any phone calls. We literally don't have anybody freaking out. And that is the goal. And the reason it's so clear now with the book of business that we have is that all the clients know that the options are being crushed. They absolutely, yes, definitely get decimated. Like they may lose 50% of their value, but they're becoming a less and less piece of the portfolio. And it's a defined amount of risk that we can all look at. And you can open up your statement or go online and see, okay, we got this much left in the fight. And you contrast that with a portfolio that is just dropping like a brick and doesn't have that type of, stop. Then that's where you're like, oh my God, what am I up against here? He still is blown away that the phones don't ring, because he shares anecdotally that when there was any kind of market turbulence back in South Africa, the phone would be ringing off the hook with clients coming unglued and freaking out. And I think that's an experience that many advisors still have. And we have a solution that can really help prevent that and do it in a way that simultaneously, potentially, can help increase the allocation to risk. And instead of backing away from that S&P 500, that gorgeous engine that is going to do well for us if we can just own it long enough, it allows clients to maybe increase the allocation to that space and enjoy more of the return over time.
I love it. And it's bittersweet too. So when things go sideways, you're going to get calls. Okay. If things go sideways, it's also a blessing that they do call you. Maybe they're upset or confused or whatever it is. And you're saying, I actually don't get those calls. And would you say that's a big part of just how you prep and how you train clients when they first join?
Absolutely.
They either jump into your ETF or something on the side. But when they first do it, I think a lot of what you're saying is we don't get calls. I'm guessing that it's because of you front load a lot of the disclosures and you help them really understand what they're getting involved in before they get involved. As I say, whatever you decide to do, just make sure you do it with your eyes wide open. Is that a little bit of your strategy as well with clients and dealing with that?
100%, because I much prefer that a new client goes through the experience of having a rising market and sees how quickly the portfolio can grow along with the index, right? And we can point out, okay, it's all happening over here because of the option going up in value. While I'm having that great conversation and a good outcome conversation with an early adopting client, I am adamant about having the reality check that says, now this could have gone the other direction. We could have been having a conversation where these options have lost half their value or 75% of their value. And I want you to understand that conversation is coming at some point. It's not that we are not going to lose it. It's just going to be a question of when. And when we do, I don't want you to lose your courage and tell me, freak out and say, we're not going to sell the treasuries and buy more options. That's a waste of money. I'm going to fight you on that, because it's the strategy that will help us make it through this process while simultaneously defining how much drawdown risk we're taking. So the real job on the front is to make sure that the client can in fact lose the amount of money we're talking about losing. So in the ETF, it's a one risk sleeve. We only have, the budget is 15%. In the privately managed accounts, that is the majority of our firm's assets, that we can do on a custom basis. So if Ryan, if you're a baller and you want, 22% of your portfolio at risk, we can do that for you. If you want to bring your mother's account to us and she's, got a little more timid, we can do a 6% allocation for her. So it's very customizable down to the client. And that makes it very, very, bespoke, so that we can likely not have a freak out conversation during a market decline.
One of our earlier guests, she was on TED Talk and communications and leadership and all that. She calls it the zone of freaking out, the ZOFO. So sometimes leaders can get there, clients can get there. And so letting cooler heads prevail through actual facts, logic, reminding of the strategy, the disclosures, those are important, right? And that's why we have the rules. And that's why the US capital markets are some of the strongest in the world, is because they require a lot of upfront, I would say. So you're the licensed guy, so you definitely would know. So it's one thing to build a strategy, but it's another thing to scale it to 100 mil and beyond. And I'd love to talk a little bit about how you scale this for advisors without blowing up compliance.
Mm-hmm. Launching the ETF was really the key to making this a scalable venture. We've been working with external advisors. First, I should back up and just say we made the decision to actively start to solicit and court other advisors, because if I'm going to be clear here, what we're trying to build is an opportunity for people to invest in the capital markets without taking the brunt of the capital pain when things go wrong. That's an experience that my father had, which was terrible on him. He worked for a big oil company for his whole career. He retired young, like in his 50s, and then instead of taking the pension, he took a lump sum, invested with an advisor up in Northern California, and within a very short period of time, that thing unwound into a Ponzi scheme. And his losses were tremendous, right? So I watched my dad basically change over the course of about 18 months from a gregarious, successful, pleasing man to just a shell of a person. That when I get serious about it, I'll say that my dad didn't die until about 10 years ago when he was 85, but he actually passed away in his 50s. And that is devastating. It really is. And for some people, it's a total loss of a portfolio or something. But for other people, they can have the same type of emotional pain and shell shocking from just having a 10 or a 20% loss that's out of control. They lose their ability, or they lose their perceived ability to make valid decisions on what to do with money. And that's what I'm trying to solve. So as far as scalability, it's a long answer to scalability. I want to impact more families. I want to improve more outcomes for people. And I know that the way to do that is to allow them a process where they can increase the allocation to equities and survive it, really be able to stay with it. That's really the goal we have as advisors, is to keep the investments in place so they have long enough time to actually perform and deliver the services to the client. So scalability, we were grinding it out, honestly, in the SMA space, because the amount of paperwork and the regulatory requirements to onboard a client through a relationship with another advisor is daunting. Thank God for DocuSign, because if it wasn't for that, we'd be personally responsible for devastating the forest. The amount of paper that was required to onboard somebody was ridiculous. So at least with the advent of DocuSign, the 33 signatures and all the forms required is at least, somewhat palatable, but it's still a big lift. The ETF is so simple. It is literally just a ticker symbol, SNTH, and it's available on most platforms. And you can just, in a brokerage account, right click, enter the number of shares and hit buy, and now you own it. So, it's just unbelievably scalable from that perspective. And then from let's call MRP 2.0, this strategy of SynthEquity can be applied to different underlying securities. So we are incubating right now a version that we are looking to potentially use for the QQQ. And then we might have a type of a fund that would be geared a little differently. So right now we can build a ratio for the S&P. It takes about 15% in options. We may consider launching one that maybe attempts to do 150% of the movement of the S&P for only a slightly higher increase to the options. That way you could actually juice up the return potentially in exchange for a higher drawdown rate. So there are more products in the pipeline that are likely going to be launched, in the near future.
Brilliant. I love that. So that's how you scale, is to say, when you started, you tell me if I got this right. So when you start SMA, more that bespoke model, that's where you started, and it worked well, but scaling, right? So we say grinding is additive, systems are multiplying. And so when you have a system that allows you to scale, now you can start to get a new form of growth, which allows you to get further faster. Didn't you say you got to like 100 million in 6 months or something like that with your ETF?
Yeah, we launched in March and we crossed over $100 million today as we're recording this, like literally today. And that's just a little over 6 months.
Just over 6 months. Good for you, man. That's one heck of a way to raise some capital. I love it. I'm a big fan. So since the S&P is mean reverting, are you guys concerned at all with underperforming once the S&P goes below the 8% average?
I'm not. If you look at the long-term average of the S&P 500, again, you have to know when you're starting and when you're ending to get an exact number. So for compliance purposes, we're just going to use a rough, kind of not a wives' tale, but the 8 to 10% is what people would consider like off the top of their head, the kind of the return you're looking to get over time. If you measure one period, it could be negative 6%. If you measure a different period, it could be 22%. So it's very time sensitive to when you start and end you're measuring. But if we use a rough idea of 8 to 10% annual long-term average, it rarely arrives between 8 and 10%. The way the market delivers that 8 to 10% return is years that are 20%, 24%, minus 16%, minus 34%. Keep in mind that 8 to 10% average includes the big drawdowns, like the tech bubble that lasted almost more than 2 years and drew down 49%. 08, which was a 53% drop from peak to trough. And then just recently, the COVID drawdown was almost 34%. And that was just over the course of like 19 trading days. That 8 to 10% return includes those drawdowns, right? So imagine the kind of success you can have if we can eliminate and engineer out those big drawdowns and still participate in the big run-ups. And then we have to digest that occasionally when the market's not very strong or has a modest loss or a modest gain, we're going to deliver some losses potentially in there. We still expect to be able to deliver that 8 to 10% return. Now, the frequency of distribution in the S&P, this hasn't changed much whether you measure over 30 years or 50 years or 60 years. But the highest frequency, the most common rate of return is like above 20%. That is nuts, but that's where it is. That's where the most hits are. And the next is between 5 and 15%. So most of the time, literally about 55% of the time, you're going to get returns that are going to be perfectly suited for this strategy. And then you have another 10% or 20%, depending on the measuring period, where you've got losses that exceed 15%. And we should do well in those environments because we won't go down that hard, or we shouldn't go down that hard. So I'm not concerned. I can't know when the market's going up, and I don't know when the market's going down. So I know the market goes up more than it goes down. And I just position the portfolio and the strategy by its structure is designed to participate if the market rises and limit the damage if it goes down. And I think that's the best we can do.
Brilliant. My final question for you before we wrap things up, what does the future hold for SynthEquity 2.0? Where do you go from here?
Well, we are in a process as a small fund that we have to grow up and get out of adolescence. And that happens really, you can't increase the time, but for most firms, most big firms, we don't even get to qualify for due diligence review until you're over $100 million and over 1 year of investment trading time. So I can't make the time go faster, but I've already hit the dollar benchmark. So for us, when that happens, when we roll into March of next year, we'll have a year under our belt, and then we can start knocking on doors that open up an opportunity for much bigger scale. That's going to allow us to potentially get into the large brokerage firms and become part of advisor models. And again, it's almost like when you hear about a company being added to the S&P 500, it's almost instantly accretive to the share value because all of the investment vehicles that are statutorily, looking at the S&P 500 as their benchmark have to buy the stock. We're not quite that, popular yet, but what will happen is that we'll get those doors open for us when we check off these boxes, and that's coming. And then when that happens, then we expect to really be able to scale significantly.
Brilliant. So before we wrap things up, is there anything at all you'd like to say, closing remarks, where people can go to get more information, anything at all?
So the website, measuredriskportfolios.com, is a place where we post all of our information, how to reach us. There's a section in the top right you can click that says chat with an expert, and that would take you to a page that you can choose whether or not you're a retail investor or you're a professional who would like to consider looking at us and working with us. And that, whichever one you click, will take you to an appointment structure where you can click and set an appointment with us. And what I'd like to offer basically is this. If you have an investment portfolio, we have the tools to be able to review it and build for you a report that shows what type of risk you're taking historically for the return you're earning historically. And we can do that by taking what you own and seeing what those portfolio positions have gone up and down, what type of volatility they experience, and what type of earnings you've achieved as a result. And it's been my experience that we can do one of two things. We can either match the rate of risk you're taking and improve your potential rate of return, or we can keep your return the same and reduce your risk. And each client may have a different opinion about what's more important to them. So typically we find the younger clients would like to have greater return for the risk they're currently taking. And maybe the older clients who've already gotten to be successful and have an amount of capital that they're comfortable with would much prefer to have the same return, but lower risk. So that's what I like to offer out there.
I love that. So just to summarize everything Larry and I spoke about, when investing and building your thesis, try building a risk-off strategy as you do your research. Second thing is ensure you possess the discipline to stick with the strategy or the person who created the strategy to avoid the zone of freaking out. And finally, always do your research and talk to financial and legal advisors. You do these things and you too will be well on your way in your pursuit of making billions.